Welcome, everyone, to this Saturday, May 11th edition of Earnings Beats Weekly Market Report. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. And it was kind of an interesting week last week. If you recall, the Friday before, we had the jobs report come in, and jobs were much weaker than expected, which, I mean, they were still positive, so that was good, but they came in weaker than expected. And then last week, on Thursday, we had the initial jobless claims jump unexpectedly from about the 210,000 level up to about 230,000. Got an interesting chart on that I want to show you a little bit later in the show. But yeah, I mean, overall, a little bit choppy, but bulls in the end, I think, pulled it off. We saw a little bit more strength in value than we did in the growth area. Again, a couple of charts I want to show you there that I think will help explain and illustrate what we looked at last week and what that could mean for weeks ahead. Well, let's go ahead and take a look at some of the major indices and how everything wrapped up last week. So first, let's start with the Dow Jones. The Dow Jones Industrial Average finished up last week. You can see we actually have had 7 consecutive gains now, daily gains on the Dow Jones. So we were up every day last week, and the Dow moved back up above 39.5. Going back, looking at the about a month and a half ago, our high close was 39,781 on March 21st. I don't think we eclipsed that. Actually, we did eclipse that. The high close was on March 28th at 39,807.37. So we've got probably about another 1% or so, and the Dow Jones would be in all-time record high territory. So after the dip that we saw in April, the Dow's moved back up and pretty much gotten all of those losses back as we approach perhaps what could be yet another all-time high. And it could be as soon as this week coming up. So that'll be one thing to keep an eye on. Moving on, taking a look at some of the other indices. We had the S&P 500 finish. I think we were up 6 of the last 7 days on the S&P 500, but we did gain, I think, close to 2% on the S&P last week, and not too far from setting a new all-time high on the S&P. So again, very good action in that area of the market. NASDAQ 100, probably a little bit of relative weakness relative to what we saw in the S&P 500, but nonetheless, we did still see the NASDAQ record gains 5 of the last 7 trading days, and not too far from the record high territory that was, or the record high number that was set back in March. So NASDAQ also looking pretty good here. S&P 400 mid-cap index also turning back up, still got a little bit of room to the upside, probably about another 1.5% or so, maybe close to 2% to get the breakout there. Small caps, you can see also turning up. Small caps earlier in the week benefited a little bit from the 10-year Treasury yield dropping, but then we saw that 10-year Treasury yield come back up again late in the week, and as a result, we saw a little relative weakness in the small caps on Friday. But otherwise, it was still an up week, getting closer and closer to those all-time highs, or at least not all-time highs on the Russell 2000, but on some of the indices, but at least 2024 highs. So we'll watch this upcoming week, see if we can take out some of those levels, but at least it was a move in the right direction last week. Dow Jones Transportation Average finally showing a little bit more strength in terms of finishing at or near its high. We did close just about right on that 50-day moving average. The transportation average finished at 15,597. The 50-day moving average was 15,579. So we closed just above it. We've gotten back through that triple bottom where we had taken that out to the downside. We had really struggled at 15.4 trying to get back through there. We did finally clear that at the end of the week. So things are at least looking better on the transports on a relative basis. Still not great action there, but improving. And right now we'll take improving. The 10-year Treasury yield. So we had recently gotten up to that 470 level, just a little bit above. And you can go back to the gap lower at the beginning of November, where we had opened just below 470 and we struggled to get through 470 then. And after moving all the way back up to 470, we struggled again and started to roll back over. So we did finish the week at 450, coming off earlier lows. We got down to 4.42 earlier in the week. And again, that was helping the small caps, mid caps, and so forth. But that kind of changed heading into the end of the week. And as a result of those yields moving back up a little bit, we saw a little relative weakness in small caps in particular. One other thing that came out at the end of the week, and I wanted to talk about this a second, consumer sentiment. So it is the University of Michigan consumer sentiment. If you go to stock charts and you type in dollar, say $, UMC, so that's University of Michigan, C, and then SENT, that's University of Michigan consumer sentiment. So again, dollar, UMC, SENT. That will give you the readings. Now, this comes out once a month. So I plotted it on a monthly chart. And you can see where we finished just this last reading, down at 67.5. That was a big drop from 77.5 that we had seen in the reading prior. But I want you to notice one thing about sentiment. When sentiment is at its worst, when it hits its bottom, generally the stock market also hits a bottom. So you might think that when sentiment's poor, that might send the stock market lower, but that actually tends to mark bottoms. This, I think, will show you pretty clearly at the end of 2008, early 2009, these final lows that printed came right at the bottom on the S&P 500, which occurred in the first quarter of 2009. If you go back out to 2011, remember we had some weakness in the market over the summer of 2011. That bottom printed almost exactly with the bottom in the consumer sentiment reading that occurred at the same time. If we fast forward to June, remember in June of 2022, I had called a bottom in the S&P 500. It was on June 17th. Check out where we bottomed on consumer sentiment, almost exactly at that time. Now, right now, what we see is consumer sentiment rising. Yes, we've had pullbacks along the way, but overall, we're moving higher. And if you look back off the low in 2011, do you see what happened as we kept going up, up, up? The S&P 500 kept rising right along with it. And then with some of these big drops, especially heading into 2022, we saw consumer sentiment beginning to tumble. It lost the low or that support that it had back in the early part of 2020. And once that gave way, the stock market topped. We ended up going down. And like I said, we saw that bottom on the sentiment reading just about the same time that we had a bottom in the S&P 500. We did go down one more time into September, October before we saw the S&P 500 turn back up along with sentiment. So yes, the sentiment reading came in much below expectations last week, but we'll need to watch the ones coming up, because if they turn right back up like they've been doing over the course of the last year and a half, that would likely coincide with yet another high in the S&P 500. If we keep going lower and the market keeps trying to go up, that could create a problem down the road. So it's going to be good to watch it from either a bullish or bearish perspective, depending on how this plays out. Moving on to the sectors. So what I've done is I've pulled up 5-year weekly charts on these sectors. You'll see the RSI here in the middle panel. And then down below, I've put in the sector divided by the S&P 500 so that we can just see relative strength over these 5 years. So technology from an absolute price standpoint, I think it looks great. And in fact, the only time we tend to see the RSI go below 40 is when we're in a cyclical bear market or potentially a secular bear market. It generally requires a bear market to get the RSI reading to move below 40 and to remain there for any period of time. We saw it in 2020 during the pandemic. We saw it again throughout 2022 until we put a bottom in. But if you look at any other period during these 5 years while the XLK has been rising, anytime the RSI has fallen below 50, it's represented a great buying opportunity. Here, you can see in October, That was right before a big move to the upside. More recently, when we saw that April weakness, we saw the RSI, weekly RSI dip on the XLK below 50. What has happened since? We've moved right back up above that 20-week moving average. But you could go back and see, anytime. Here was one back in 2019 where we went just below the 50-day. We put in a bottom, started turning back up. Or I may have said 50-day, but just 50, RSI 50. There were a couple of other readings where we were in the 50s, didn't go below 50, but when we got down into the 50s, that marked bottoms. So RSI, when you're looking at it, whether it's daily, weekly, monthly, whatever, that 40 to 50 zone, when you're in an uptrend, tends to provide really good support. That's what we saw here on the XLK. And as far as relative strength goes, yeah, we've pulled back for the last few months, but overall, this trend has remained strong in terms of the relative strength of technology. If the stock market keeps moving up for the next few weeks and we move to all-time highs and we keep seeing this XLK relative strength drop, that's going to be a warning sign for the market. It's not going to be the only sign that we need to pay attention to, but that would be a warning sign. Technology represents about 29% of the S&P 500 right now. That's about the weighting of technology stocks. So if technology is not outperforming the S&P 500, it generally weighs on the index and makes it very difficult for that S&P to continue moving. Let's keep going. XLY, I'll go through these other aggressive sectors with you, but the XLY, even though it's not perfect, we obviously had a really rough time in 2022 during that cyclical bear market, but we have been trending higher since then. And again, look at what happens when that RSI gets down to about 40, with the exception of these cyclical bear markets, when we tend to go into the 30s or even into the 20s. But right now, we're still well above that 40-50 support zone, and I think supports the XLY going higher. XLC, which is communication services, went all the way back up just a few weeks ago and tested the high that we established back in 2021. So from that point forward, we really struggled in communication services, but we have come all the way back, gone all the way back to that high, pulled back to the 20-week EMA, and now we're starting to turn back up again. A breakout would be very, very bullish for this group. The industrials, what are you going to say? I mean, we broke out back in December of last year, taking out prior highs, and we've continued to push higher, continue trading above that rising 20-week EMA. And again, anything back down in the 40s has generally represented great entry into the industrials, with the exception of the pandemic and the 2022 cyclical bear market. Financials also breaking out, taking out the highs from 2022, pulled back a little bit, got close to that 20-week EMA, and then turned back up again. I think this group continues to look very strong as well. Now, the beauty of what we've seen recently, I know on the one hand, we don't necessarily want defensive groups to lead, but we do want wide participation in any secular bull market. So I want you to take a look just quickly at these charts. Consumer staples just broke out to another all-time high. XLV, healthcare, after sideways consolidating, unable to get through that 140 level for probably 2 years. We got through that 140 level, got up to almost 150, pulled back to around 140, starting to turn back up again. So we're getting that absolute participation from these various groups. Probably the weakest of all has been real estate. We topped at the beginning of 2022, really have never gotten back up there, although maybe we're starting to turn back, and maybe real estate will catch up in time. Still relative laggard for sure. Utilities almost back up to the all-time high that we saw back in August and September of 2022. Then you got energy. Energy just recently broke out, pulling back. Materials broke out after years, 2 or 3 years of sideways consolidation. So what we can conclude from all of this is that technically, outside of maybe real estate, 10 of the 11 sectors, in my opinion, still look very bullish. That is the wide participation that we were talking about. So I know a year and a half ago, everyone kept saying, well, it's the Magnificent Seven. breadth is lagging. That's all bad. Market's going to go lower. Well, actually, the market's done the opposite. The market's kept going higher, and instead of the Mag 7 just being the only leaders, we've seen that leadership spread to many areas of the market, which again to me is very bullish, because where do the shorts turn? If every group is trending higher, where do you want to short? So yeah, money is rotated away from technology and away from discretionary to some degree here over the course of the last few months, but the money is not leaving the market. The money is actually rotating into some other areas that had been lagging for a while. So I view this as very bullish action. I don't think we're completely out of the woods, but I think that there are enough signals right now pointing to higher prices. I wouldn't fight it. Moving on, let's take a look at the S&P 500. Here is a chart of that S&P I showed you earlier, but this time I've added some growth versus value ratios down at the bottom. So the IWF, IWD, you can see that's large cap growth versus large cap value. It had been going up, but since February, it's been downtrending. Now, moving into May, what did we talk about? We talked about the fact that growth tends to perform strongly from the month of May through the month of August. These 4 months, historically, throughout this secular bull market, that's where most of growth's outperformance has come from, during these 4 months. So it's noteworthy that we did turn back up again to start May. We pulled back last week, but we're still above where we were in April, at the end of April. I'll be watching these indices to see if we can continue to strengthen as we move over the course of the next few months. If we do that, and it's occurring simultaneously with more all-time highs in the major indices, that's going to be really bullish action. So definitely let's keep an eye on that. Now, when we look at the mid caps and small caps, growth versus value, we are still declining. Mid caps look like since the beginning of May, we're about break even. Small caps may be up a little bit, growth versus value, but they're not as strong as what we've seen at the large cap level. So far, though, so good here in May, and we'll see whether or not that return to growth occurs next week. Let's see. Another chart I wanted to show you, the XLY XLP. Now, this is a chart that I track on an intraday basis. So I have to do some calculations on my own in an Excel spreadsheet. And then I use a user-defined index at Stock Charts to track what I'm tracking, what I'm developing. And so I like to look at the XLY XLP, including gaps, which is just XLY XLP. You can do it anytime. And that includes gaps. That includes everything. If I strip out the gaps, though, and I only look at what's taking place from the opening bell to the closing bell, that's what this top panel represents. And I'm okay with it as long as it's in this sideways consolidation that it's in right now. But it has been downtrending for probably the last 3 or 4 weeks. And we are now getting close to the 2 key support levels that I'm watching. So this is one of those, where I'm saying we're not quite out of the woods. This would be one of those charts that would make me think that. All right, next up, this is the initial jobless claims. So if you go over to Stock Charts and you type in dollar, I'll kind of zero in here so you can really see this. $, UNEMPCIN. So it's basically unemployment claims initial. But that's the ticker symbol you need to get this information. And it comes out weekly. So I choose a weekly chart. Now you can see that the claims were high in 2020, of course, with the pandemic, and then we steadily moved lower. We got down to around this 200 range. We've gone a little bit below, a little bit above, but you can see we've mostly been hovering in this area for more than 2 years. Last week, we saw that big jump, came on Thursday, where the market was expecting 210,000, or maybe it was 212 or 209. I don't remember exactly where it was, but we came in at 231,000. And again, that number is right up here. So you can see it right there. 231, which is above. I have a 50-week moving average, which is 221. So we were below the moving average. We were expected to stay below the moving average, but we jumped above it. Now, is that a problem? Not yet, but I do think it's a warning sign. We have had other occurrences where we've seen the initial jobless claims rise from week to week more than 10%. That's what we did last week. So we did it in November. You can see all of these. Let me annotate this. That might help here. So that's the 10% level right about there. And you can see that we've had, since 2020 or since May of 2020, we've had 1, 2, 3, 4, 5, 6, 7 previous times prior to this past week. 7 previous times we've seen the initial jobless claims jump more than 10%. In all 7 of those instances, the jobless claims came right back down the next week. So it's almost like, I don't want to say rounding because obviously this is bigger than rounding, but whatever has triggered the jump in initial jobless claims goes away the very next week. So this Thursday, I'm going to be watching to see if we have another big pop. I mean, if we go from 230 to 250 or 255, that would be a little bit of a shocker for the market to absorb. So that's one thing I'm going to be watching. Of course, I already talked about a number of things I'll be watching, but that'll be one on Thursday of next week, because my guess is that we're probably going to go back either down to the zero line, or maybe we'll see those jobless claims jump or drop back down, meaning that the 1 week rate of change will drop into negative territory. And we've, done that plenty of times after gaining 10%. So that's something to look for. Here is the rate of change over the last 4 weeks. And so over the last 4 weeks, you can see that, every time we get up near that 10% level or just above, we tend to roll back over. I also pulled it up on a 13-week basis, which is basically 1 quarter, and then 26 weeks, which is a half a year. And both of those, really not moving much. The needle hasn't moved because every time we get a little pop, we come right back down again. Do we come back down this Thursday? Tune in. All right, coming up this Tuesday, we've got the PPI report. On Wednesday, we'll have the CPI report. And this is a chart of the CPI, the monthly CPI. The way you get this at stock charts, $, CCPI, core CPI. So if you didn't want the core, you could just put CPI in. Or you could put $, PPI or $, core CPI. That's how you get those 4 different readings over at stock charts. But I always pull this up on a monthly chart, and then I use a 1-month rate of change and a 12-month rate of change on my charts. So this tracks the month-to-month bumps, which we have seen over the last year, mostly between 0.2 and 0.4. Now, we did have the April 2023 core CPI come in at right at about 0.47, 0.48, something like that. And that's what we're going to have released this Wednesday. It'll be the April. So whatever we get this week will replace this higher reading from a year ago. So if we come in at, say, 0.27, let's say that's 0.47, our annual rate will drop by 20 points. We'll drop from 380 down to 360. The only way the annual rate is going to go up above 380 this quarter or this month is if we have a reading that is higher than what we had a year ago. And that would be, like I said, up around 0.47, which would be the highest reading over the last year. So I don't think that's happening. If we, like I said, if we come in at 0.3 or 0.4, that annual rate will drop. So if it comes in below expectations, we could see a major surge higher in the market, and we could see that 10-year Treasury yield take a hit to the downside. That could be the catalyst for the small caps to break out. Now, again, I'm assuming the number comes in better than expected. If it comes in worse than expected, we could have more problems on our hand in the short term. So watch for the inflation reports Tuesday and Wednesday, especially Wednesday with the CPI. 10-year Treasury yield. So 10-year Treasury yield came down last week. Remember, jobs came in below expectation prior Friday. And that was when we saw this decline right here, coming down from close to the 460 level. And then, of course, the jobless claims jumping this past Thursday. I think also you can see that Thursday moved down in that 10 or in that, in the 10-year Treasury yield. So any kind of weak economic reports, we see that come down. Strong economic reports would have the opposite effect because the market would start to think, oh, if the economy's strong, that could still create some problems with inflation. So either way, stronger economy or higher inflation, both of those trigger higher interest rates. Last chart I'm going to show you for today, the Volatility Index, the VIX. You can see what happened when we topped in October. That was when we hit the bottom of that correction of last year. The VIX topped right at just a little above 20. And then you can see this precipitous drop in the VIX. We went from above 20 to down to 12.5 in probably about 4 weeks. And what happened when that VIX dropped? When that VIX went back down below 20, the market bottomed. When it went back down below 17, we saw a pretty big pop to the upside. And then as we kept going down, we saw the S&P keep rising. But look at this, even though the VIX rose throughout this period, it remained below 17. We never had a close above 17. And during this period, look what happened with the S&P 500. The S&P 500 historically goes up when the VIX is below 17. It even goes up when the VIX is between 17 and 20, but the gains become less and less. When you really have to worry about the stock market is when the VIX is above 20. I've been harping on this for weeks and weeks, months and months, years and years. We have never seen the beginning of a bear market decline when the VIX is above 17. We have never seen that VIX go back down below 17 again, not during the cyclical or secular bear market. When we break back down below 17, that is essentially a all-in kind of a signal. Get in the market. And since we have continued moving down, look at what we've done on the S&P, threatening now to break out to an all-time high. And the VIX is now down at 12.55. The best time to be in the stock market is when the VIX is below 13. Throughout this entire secular bull market, I've done the studies, I've calculated returns, and I believe the return on the S&P 500, the annualized return, is over 47% when the VIX is below 12 or below 13, and we're at 12.55 right now. So if you want to bet against this market, you go right ahead. I'm not going to. I'm sticking with my guns. I believe the stock market goes higher. I am very bullish long term. I'm growing more and more bullish short term. But I mentioned some things we need to watch out for in the week ahead. As long as that continues to, the time passes and those things don't upset the apple cart here, I think we go higher. Anyway, have a great day, everybody. I do want you to make sure you like our video, subscribe to our channel, and check out our Fab 5, which will be out later this weekend. Make sure you do all that and have a great rest of your weekend. Happy trading.